Welcome to the Explainer. Today, we're diving deep into the AI investment memo, and we're putting a massive global data giant right under the microscope. We're talking about Experian. Now, if you follow the financial markets, you already know Experian. They're one of the big three credit bureaus alongside Equifax and TransUnion. But today, we're not just doing a basic overview of what they do. We're coming at this from a highly skeptical buy-side investment perspective. We really want to figure out what this data engine is actually worth, the real risks they're facing, and honestly, whether they're a hidden opportunity in today's market. So let's just jump right in.
Okay, I want you to think about this number, 0.68. This is basically the hook for our entire analysis today. According to Morningstar's heavily researched valuation models, Experian is currently trading at just 68 cents on the dollar. That's compared to a Morningstar fair value estimate of $55 a share. You know, when you have a highly profitable, deeply entrenched market leader trading at a 32% discount to its estimated intrinsic value, well, that absolutely demands our attention.
And the historical data perfectly illustrates that exact valuation gap. There's a massive stretch recently where the stock has been sitting squarely in undervalued territory, based purely on their cash flow models. So this sets up the big question for this explainer. Why exactly is this highly profitable data machine trading at such a steep discount right now? Is the broader market just missing something? Or are there hidden underlying risks dragging it down? Well, to figure that out, we need to break down the business itself. First off, let's look under the hood at how Experian actually makes its money. Even though they're absolutely a global player, North America is the undeniable engine here. It drives the vast majority of their business. Then you have Latin America, Brazil in particular, serving as a really strong secondary pillar, followed by steady contributions from the UK, Ireland, and the Asia-Pacific region. And what's really fascinating is that this geographic mix, which is powered by selling data to businesses while also offering tools directly to consumers, has steadily pushed their total global revenue past that $7.5 billion mark. It's a massive, highly diversified operation. Because of that massive scale, Morningstar assigns Experian a wide economic moat. But what does that actually mean in the real world? Basically, it means Experian has built a structural business advantage. They have proprietary data assets and advanced analytics that form an almost impenetrable barrier to entry for any new competitors. They operate this brilliant dual business model. On one side, they sell absolutely critical underwriting and fraud data to banks. That is incredibly sticky B2B revenue. But on the flip side, they offer credit reporting and identity services directly to consumers. And this creates a continuous, self-reinforcing data loop. Consumers interact with Experian, providing more data, which in turn makes the analytics Experian sells to the banks even more valuable. It's a feedback loop that is just incredibly difficult for anyone to replicate from scratch. To really grasp the power of that consumer side of the loop, check out this number. Over 200 million. That is the sheer scale of Experian's global free member consumer base. We're talking about everyday people signed up for credit monitoring, identity theft protection, and various financial tools. Now, Experian isn't just giving all this away for free out of the goodness of their hearts, right? This massive audience drives incredible recurring revenue and cross-selling opportunities. They upsell premium subscriptions, they route users to loan and insurance marketplaces, and of course, they gather incredibly rich behavioral data. Management has essentially built this gargantuan top-of-funnel audience, and they're just getting better and better at monetizing it. So let's talk about how management is actively building on this foundation, because they definitely aren't just sitting still. They're using their massive cash flow to aggressively expand that global moat through some very strategic acquisitions. Step one was picking up a company called Elian to heavily bolster their presence down in Australia and New Zealand. Step two involved acquiring ClearSale to deepen their already dominant position in Brazil. And step three is where it gets really modern and exciting. They are integrating cutting-edge AI and behavioral biometric tech through acquisitions like NeuroID. Basically, they are actively buying up unique datasets and next-gen fraud prevention tools to future-proof the business against new technological threats. Okay, so how does all this grand strategy actually translate to the bottom line? Well, Experian has incredibly strong upward financial momentum. They're consistently delivering solid mid-single-digit organic revenue growth. But the absolutely crucial point here is their efficiency. Thanks to strong operating leverage and a major transition to cloud infrastructure, their operating margins are steadily widening, recently hitting an excellent 28.1%. And here's perhaps the best metric of all if you're an investor. Experian converts a massive 97% of its earnings directly into free cash flow. This isn't just paper profit, folks. It's a highly efficient cash-generating machine. And what exactly do you do when your business generates that much consistent cash? Well, you reward your shareholders.
Management is clearly highly confident in their balance sheet and their future cash position. Not only have they maintained a steadily growing dividend, but they recently launched a massive $1 billion share buyback program. And as you probably know, when management uses cash to buy up their own stock, it's usually a very strong signal that they themselves believe the shares are trading well below their true intrinsic value. Okay, so if the moat is dat wide, the growth is steady, and the cash is flowing, why the steep discount? Why are we looking at 68 cents on the dollar? Let's pivot to the elephant in the room, the bear case. The market's hesitation right now is largely driven by intensifying regulatory heat. Experian recently faced a 2.7 million euro GDPR fine in the Netherlands over their privacy practices, and over in the US, there's a looming Consumer Financial Protection Bureau lawsuit alleging poor dispute investigations. And remember, since credit bureaus don't get government bailouts like banks do, these fines hit shareholders directly. Beyond the regulations, they're highly vulnerable to the macro credit cycle. Basically, if lending slows down, demand for their data slows down. And finally, there's always the looming threat of tech disruption from fintechs who are using alternative data to try and bypass traditional credit scores entirely. So, weighing all of these incredibly strong fundamentals against those very real regulatory and macro risks, what's the final valuation verdict from the investment memo? Well, our analysis models out several scenarios. In a conservative base case, assuming slower growth and steady margins, the fair value sits somewhere around $40 to $42 per share. But in a bull case, assuming they successfully leverage their new AI tools and expand those margins even further, fair value jumps up to around $54 to $55 per share. So the crucial takeaway here is that even in a highly conservative scenario, the stock currently shows real upside. The memo concludes that this is a moderate buy, offering a very attractive risk-to-reward ratio for investors with a 12 to 18-month horizon. Which brings us to our final thought. You've seen the data today. Experian possesses deep, almost impenetrable data moats. They've got widening profit margins and a $1 billion buyback backing up management's confidence. Yet the stock sits under this cloud of regulatory scrutiny and macroeconomic sensitivity. So the question you have to ask yourself is this tension creating the ultimate value play that's currently missing from your portfolio? It is a fascinating look at how markets weigh structural business strength against external regulatory fears. Take these insights, take a hard look at your own investment strategy, and see how it fits. Thank you so much for joining me on this explainer. Keep learning, keep analyzing, and I'll catch you on the next one.